The Fed recently made a surprise move by cutting interest rates. And the big question I keep getting from buyers and sellers is, will this finally bring home prices down? Let's dive into what this means for the real estate market and what you need to know. As a real estate expert, I've been watching closely the shifts in the market this past year. The Fed just cut its key rate by 25 basis points, with hints that more cuts might be on the way as soon as this week. That sounds like a win for affordability, right? Well, in theory, sure, but here's the twist. Lower interest rates doesn't always lead to lower mortgage rates and lower prices. Here's why. Number one, rates and prices don't move in sync. Mortgage rates have gone down recently, with a 30-year average down to about 6.17% at the time of this recording, which is a big drop from over 7% earlier this year. But in the past, even when rates dropped, we've seen them go back up because of things like inflation or even investor jitters. Buyers this fall shouldn't expect home prices to drop just because rates are lower. Number two, inventory is increasing, but it is still tight. Yes, inventory is going up. In some areas, it's up by almost 20% compared to last year. Builders are offering incentives on condominiums and townhomes, and some sellers have adjusted their price expectations, and some overheated areas are now eventually cooling. That's good news for buyers. But overall, we still don't have enough homes for sale as we did pre-pandemic, and that's keeping prices firm in most areas. Number three, what sellers should know. If you're considering selling your home, understanding local conditions is more important than ever. Not all housing markets are moving in the same direction right now. In some neighborhoods, buyers are gaining more leverage, while in others, demand remains strong. This means it's really important to set the price right from the start if you want to get results this fall. And lastly, what buyers should watch for. If you're in the market to buy, it's natural to worry about a market crash or a sudden drop in home values. However, almost all experts agree we're unlikely to see anything like the 2008 housing crisis. Why? Today's market is fundamentally different. Back then, nobody had equity. Now, homeowners hold significant equity. The average homeowner in the Bay Area has over $1 million in equity, and mortgage defaults remain low. While this lock-in effect with these low interest rates where current homeowners stay is easing, and it isn't anywhere the point of now triggering massive number of people moving and a market collapse. So if you find a home you like and it fits your budget, it might be smarter to buy now instead of waiting for a better rate later or next year. Whether you're buying or selling anytime soon, navigating this market takes a good plan and a perfect strategy. So if you want a local expert to walk you through what's really happening in your neighborhood, reach out to me at my contact information below or DM me here, and I'll be happy to help you build a smart plan for the months ahead. Thanks for watching.